Welcome to the daily update, where I'll go over the action in the market for Monday, April 22nd, and then we'll see how things look for Tuesday, April 23rd. Saw a pretty nice little bounce. Now, we did end up giving back a lot of the gains that we saw in Monday's session, but some of the areas of hope that we've been latching on to see if we're going to start to turn back more positive, a few of those areas are showing some improvement. There are other areas where we're continuing to see more weakness. So we don't want to try to front run this as far as turning from negative back over to positive. We're still negative in the short and intermediate term, but we're still looking somewhat oversold with our indicators. We're still positive in the long term, but we are seeing potentially some signs of improvement. Now, this is going to be a big week. Monday was, you thought it might have been a real sleeper session. We didn't have any economic reports and really no earnings reports of note. That's all going to change throughout the rest of this week. We're going to get the first reading for GDP for the first quarter of 2024. That could really be a big market mover because that's the first time we're seeing that number. And then we have a number of different companies that are going to be reporting earnings throughout the week. And then on Friday, we're going to get the core PCE, another major inflation reading that will be coming out. So let's go back and talk about what happened. Right at the open, we did have a gap higher open. The futures were pretty positive. We were up around 0.5%. Europe seemed to stage of a bit of a bounce, and then that carried over into the cash session. But we saw that even last week. We saw positive opens only to switch once the opening session, which is usually anywhere from 1 to 2 hours right after the market opens. That's usually when I'll go for a walk or I'll tune in to see what's going on in the news. I keep an eye on things, but it's such a crazy time. I really don't make any decisions during that time. The only time I use that is if I have a position and we're looking to gap either higher or lower in the direction of the position that I have. So if I'm long and we're looking to gap higher, I may exit at that point if my profit target has been hit, and that can be beneficial. But I never establish new directional positions during the open, and I try to wait as close to the close as possible. And I explain that in my course and my whole rationale behind that. But anyway, so we did have a gap higher open. We were above the daily pivot at 49.80. And then, very common, this is where things could have shifted. We fell down to the unchanged level, but we didn't keep going this time. We just came down to fill the gap. Prices rebounded back up above the daily pivot. We got up above R1 we went back above 5,000 at 5,006. We didn't quite get up to R2 at 5,045, and then we fell back into the close to close at R1. We were up 0.87%. Kind of interesting. Friday session, we were down 0.88%. So we recouped pretty much all of that was lost in Friday's session. We were still below average with volume, though. Friday's session was above average with options expiration. Now we're slipping back into a more below average type of scenario, at least in Monday's session. And I've kind of gone through my short little talk about the technicals, but it's about inflation and interest rates. And we're going to get more this upcoming week to kind of help see if is that going to clarify anything? Is that going to concern the markets, or are the markets going to be able to find something positive from that and then see a reason for things to go up? We also want to keep an eye on the geopolitical things. It's Passover week now in Israel, and there are things going on around the Temple Mount that could easily escalate at any time. So we just want to keep an eye on those things. Some comments that we can make. The S&P is now back above 5,000. And Tesla, it's really having a lot of trouble these days. And it's why the discretionary sector is really under a lot of pressure. It keeps going down, down, down. And of course, with each new down day, we set another new 52-week low. Bank stocks. And this was one area that I was pointing out over the weekend where we could be seeing some hope. Well, they had a pretty good session on Monday and they really outperformed other areas of the market. Oil is still falling as things seem to be at least in a point of okayness with those things going on in the Middle East. It fell and closed at $81.90. Our list is a little bit shorter in the short-term oversold conditions. We still have the Williams percent R, the stochastics, and the slope oscillator. Intermediate term, also a little bit shorter, but then we have a new addition, the ultimate oscillator. That's on the list now. And the TTM squeeze, that's another new addition. That's a momentum oscillator, and that moves a little slower. So it's still going down, but could be getting to an extreme negative reading. The rate of change going back 20 periods, the ease of movement, the PMO studies, the NASDAQ 100 bullish percent index. And I have another chart because that just went massively extreme negative after Friday. And the chicken money flow, which is starting to turn back up, but is still extreme negative. In the long term, we still have our 150 and 200 period simple moving averages that are extreme positive. And this is the scenario that we're wondering, are we going to change at all in the upcoming week? That it does look like the Fed could be done raising rates. And that was the prevailing scenario that we were going with up until we started to see these stronger than expected economic reports. And they were anticipating 3 rate cuts in 2024. That's also really in doubt right now. So the market's trying to adjust to that. Then the dollar was down and interest rates actually, they were higher, but they carry these out to multiple decimals. And in Friday's session, we rounded down to 4.62. Well, in Monday's session, we had to round up to 4.62. So it looks virtually unchanged, but interest rates were up slightly. We still have our yield curves that are inverted. Sentiment is getting a little bit better with the up day. We closed at 38 for sentiment where we had been down at 31. We are still negative with our trend, and we have to respect that. We have to go with the idea here and the fact that our charts are negative, and any kind of a bounce that we're seeing right now has not proven itself. Now, if it continues and we see more of an improvement, that will, of course, bleed over into our charts, but we need to be really suspicious of that for right now. We are negative. The ADX is still getting stronger. It's above its moving average, and both the moving average and the ADX are above 20. So we're in a strengthening, trending environment, and that trend is negative. Now, the bias, I should have changed that over to positive with the positive up day, but we're still negative when you look at the last 2, 3, 4, 5 days taken together. We didn't have any economic reports on Monday, and that's strange to have Friday and Monday back-to-back days with no economic reports. So the market was kind of left to its own devices, and it turned out to be more negative on Friday and more positive on Monday. Don't have any charts to show you. Here's some Isabel Net blog charts. We usually see this once a week. These are legal insider transactions. These, as opposed to illegal insider trading, where you're acting on information that's not available to the public. Just go back and see the very first Wall Street movie. That's why Bud goes to jail at the end of the movie. Spoiler alert. I should have said that before. But we're pretty much neutral right now. We're not seeing an awful lot of buying or selling going on. These are like corporate officers, insiders, people that really make the decisions in the company. When they buy or sell, they have to report that. And then it ends up coming out with this chart that we look at once a week. Looking at GDP, now folks are starting to shift towards that a little bit, where we're looking here. This is the first quarter of 2024, where they're expecting it to come in. At least the consensus is that we'll be at about 3.1%. And then the black diamonds here are, oh, that's the consensus, is at about 2%. Goldman Sachs is more optimistic at 3.1%. The takeaway that I get from this, whether you're looking at the gray areas or the black diamonds, are that we're positive. We're not necessarily seeing any kind of a forecast going forward where GDP is going to go negative. Financial conditions. The last time I showed this chart, it showed that we were really going down and that financial conditions were getting looser. And that was, the market was going up. There was more money available to put into the market. Well, we're seeing that really start to shift and go in the other direction. It's still fairly loose, but the trend has shifted into a more tighter type of scenario as it's going back up. And what is your view on U.S. inflation for the remainder of 2024? 35% say that they expect inflation to surprise further to the upside. 50% see it as balanced, and 13% say that it will surprise to the downside. And you got 2%, which I hope this is not the Fed, that they don't know. They're not quite sure what's going on. Of course, everybody has their opinion. We just have to wait and see how things are played out as these economic reports are released, and then they form a bigger picture that we follow. Here's a chart put out by Bloomberg and Bank of America. It just says 5% pullbacks in the S&P 500 have occurred 3 times per year. Even in a solid upward market environment, we still see pullbacks and still bumpy times along the way. And here is the blue line. That's the average of about 3.4 times each year, even in very good years. And which is looking at the mega cap growth and tech positioning. The last time I showed this chart, we were way up here, close to this 1.0. We've been falling back as folks have been getting out of some of their mega cap and tech stocks. Didn't really see anything of interest over the weekend here. We still have this cycles chart, which is now going on, well, it's over a week old, almost 2 weeks old, where if we follow the light blue line and then this kind of brown line here, this is suggesting that the weakness that we've been seeing fits into these cycles from 2006 and 2012, and we could bottom right around the 24th, which would be Wednesday. Here's our intraday chart where we gapped higher, came down below the daily pivot, came almost down to the unchanged level, and then this is when the market had to make a decision. Was it going to fall further and go negative? Well, some buying really came in, and we were able to go back above the daily pivot. We ended up really going, it's like a buy program kicked in here above R1. And we didn't quite make it up to R2. We topped out and then started to come back down and closed right at about R1. So it's positive that we had an up day, and this is the first up day that we've seen in many trading sessions. But it's negative in that we gave back a substantial part of the gains going into the close. Here's our intraday chart. We were pretty much flat when things closed on Friday, and then we had the weekend, and then they gapped higher right when the futures opened Sunday afternoon or evening, depending on where you're located, and started to see a little bit of strength, and that held on. That went over into the open of the cash session, and then here's where we saw the pullback, the strength of buying going throughout the day, and then giving up some of those gains going into the close, and we're pretty much flat right now in the initial overnight session. This is still turning a little bit more negative where we have the red line on top of the blue line, meaning that value is outperforming growth, even though they're on different scales. I like to always point that out. Even when we were coming down here, we saw the blue line on top, which is growth. In Friday's session, we saw these lines cross, and they still remained cross at this time. And we saw a really big move down in Friday's session with the growth to value ratio intraday for the S&P. It bounced up a little bit here, so it's showing some signs of improvement. Our end of day charts, we had growth was up where value was up, but not as much. For the mid caps, growth also outperformed, and it outperformed for the small caps. So Friday was just an ugly, ugly day for growth. We saw a little bit of a recovery in Monday's session. In fact, we're still going down on the end of day chart when we look at small cap growth to value here. And that's one of the more negative signs that we want to keep an eye on. We're wondering, is the market shifting into more of a defensive type of stance, which is similar to what we saw going into 2022. So that's what we're really watching for right now. And we also saw a little bit more of a decrease here when we look at mid-cap growth to value. So not much of an improvement here. And we're also not seeing a real improvement here with growth to value. So that part really hasn't shown any significant signs of improvement yet. So we still would lean towards the negative side with this. There's another ETF of growth to value. I usually show this in I think it's the intermarket analysis video, where we had been going up above the rainbow for really all of 2023. We did pull back as we were seeing some corrections back in 2023, but then we were looking really strong for the most part here in 2024. Now we're coming down. We came down to this 250 period moving average. That's the longest term moving average in this rainbow. And we're just ticking up off of that slightly. Is this starting to show that we're going to bounce further up from here? Or is this just to tease the market a little bit before it gets set to go lower and actually drop below the rainbow? We're not seeing a real improvement here between discretionary and staples. That's in the bottom where we look at the ratio. It's coming down and pretty much sitting at its 200-day moving average with this ratio. Large cap growth, this showed a little bit of improvement. We came down here to the 100 period moving average, and now that's the moving average we're focusing on right now, not only for large cap growth here, but for the S&P 500. And we settled pretty much on the 100-day moving average and then bounced up off of that. So that's more positive right now, but we need to see more follow through. The Wilshire, which was up in Friday's session, actually declined 0.25% in Monday's session. So broader market was not as strong. Keeping an eye on our trend, we still have the ADX above the moving average. That's a strengthening trend. The red line, even though it came down, is still on top. So that's a negative trend, and seeing pretty much that same thing in the short term. And after being above average with volume on Friday, we dropped to below average on Monday. Sentiment, this is the weekly chart that we look at where we're coming down after being extreme positive here. Actually, our charts are a little bit more tilted almost to the green area where it would be here. But this takes a lot of different measurements and puts them together into one overall scale. We're also seeing this really dropping off with sentiment, where when we get above this dash line, then we're extreme positive. Now we're starting to show that sentiment is dropping off here as well. Don't have an update of this chart yet. It'll be interesting to see how that changes. We're still continuing to go up with the Ulcer Index as fear has been increasing in the market. We came down with the VIX with the line chart. That's the closing value. And after going above 20, and I had a brain freeze while I was recording the What to Watch video. I couldn't remember the level of this number when I was doing that. 20, 30, 40? Well, this is 20. We spiked up over 20 on Friday and then closed back down below it. Well, we actually declined here with the bar chart in Monday's session as we saw the upward move in stocks. We're also seeing volatility, or the VIX of the VIX, continue to drop off. And we want to keep an eye on this. I don't know how much longer I'll show this. We're getting up here into other ranges where we still see positive returns. But if we really start to break above 20, that's when we start to see negative returns overall with the VIX. We came down a little bit here with our momentum, but the momentum of the VIX continues to be up. And this really came down. We saw it really spike up after Thursday, as it looked like folks were hedging ahead of Friday's options expiration. And then a lot of those hedges came off because they might have been using one-day put options that were going to expire. Well, with the update, we continue to decline again. So that is starting to turn our 5-period down, which is more positive. When this is going down, that is often positive for stocks, where if it's going up, that's more negative. And the volatility risk premium still giving us a high reading. It really hasn't dropped at all yet, showing the volatility is quite high. We came down a little bit with this fear gauge that we follow, and also declined a bit with this other fear gauge. And this is a chart that I haven't really been able to show in 2024 because it wasn't doing anything. Well, after Friday's session, we really broke down. We bounced back up just a little bit with the risk on to risk off ratio. Advanced decline line, this is where we're seeing some signs of hope. And we saw a bit of an improvement after Friday. We're still continuing to see a bit of an improvement here after Monday. We're turning back up with the advanced decline line based on price and volume. And we're also seeing that more new highs are being generated than new lows. Now, we're wondering if some of this shifting going on, it's not necessarily the growth stocks that are putting in new highs. Maybe it's the more defensive stocks that are being bought. And so we just want to watch this as it unfolds to see if the overall market climate is changing. But we're still declining with our 5-period moving average and our 10-period moving average. But it's not because we're showing a real breakdown in the overall reading. It's really because we've been seeing a contraction of the new highs. And we're still, this is another area of hope we've been latching onto. We're still negative here, but we're continuing to bounce up with our advanced decline ratio. This is still negative, though. The accumulation distribution is still below the moving average. It was pretty much flat on Monday, and the moving average itself is starting to roll over. Chicken money flow was getting quite extreme negative, and it's still negative right now, but we're starting to see it try to turn back up just a little bit. Chaikin oscillator ticked up just a little bit, but it's still negative. This is other areas that we're seeing of potential hope here. The cumulative NYSE advanced decline line continues to show some improvement, and we're also continuing to come back up with our regular advanced decline line. Also, a little bit of a tick up with our other NYSE advanced decline line. And when we look at NYSE common stock based on price, showing some improvement as well as based on volume. And we're still negative here, but we're coming back up with our NYSE new highs minus the new lows. The raw score is still negative overall. If we can get that back to positive, that would help show that we're seeing a little more strength in the broad market. When we look at the S&P cumulative advanced decline line based on price, we're continuing to tick back up based on price as well as volume. And we're showing a little bit of improvement here with our advanced decline line studies, coming back up with the NYSE common stock, the S&P mid caps, and small caps. Short term, we are trying to stage a little bit of a bounce here. We're just wondering if we're going to see any kind of improvement. Is this going to continue and actually develop into something? We don't know at this point. And the Williams percent R is just barely extreme negative for right now after it's been coming back up. The CCI 14 also bouncing back up, but still extreme negative, as well as the CCI 20. And we're seeing more improvement here. This is the 20-period exponential moving average, and it's just calculated on the price of the S&P 500. We latched onto this as hope after Friday. Well, we're still seeing it continue to go up with the 50 and 200-period moving averages. And we're no longer extreme negative with the force index. It's negative, but it's finally bounced off of this Keltner band. We're turning back up in the short term, but we're still extreme negative with the stochastics. Turning up, it's still extreme in the intermediate term. We're continuing to decline with the long-term stochastic. And we're coming back up into the -2 channel now for standard deviation, where we had gone into the -3. So that's showing a little bit of an improvement there. Intermediate term, we're ticking back up here with the rate of change going back 20 periods. We're still extreme, though, with that reading. The balance of power turning up a little bit, but is still negative. The go, no go is still giving us these purple bars here. So that's negative. And we're bouncing up a little bit with our lowest low value, but we need to see follow through here. The TTM squeeze coming down to this black line. Again, I always have to point this out. I put this black line on here just as a reference point. And to give you some further perspective, I also included the longer term version of this chart where you can see other times where we came down to extreme negative readings. And we can even go below that. But this is where we really start to keep an eye on this a little bit closer. We're continuing to show weakness with our double and triple exponential moving average based on 50 periods, even though we did bounce up on Monday. We're below the 50-period moving averages. That happened a week ago. We're still below that. So as long as we stay below that, that is turning the intermediate term more negative. We're watching the 100-period moving averages now. Is this going to provide some kind of support? We never really got down to this, so we haven't hit it directly. But are we going to be able to stage more follow-through upward price action from here? That's what we're waiting to see. We're turning back up a little bit, but we're still extreme negative with the ease of movement. And this tries to measure the path of least resistance, which clearly has been down. Well, in Monday's session, it showed a little bit of an improvement. The Erin indicator is pretty much flat now, but it is also negative since the oscillator is below zero. And we're no longer extreme negative with the S&P McClellan oscillator. We had become extreme negative. We showed signs of hope after Friday, and now we're bouncing back up after Monday. We're still negative since we're below zero. If we could eventually, or actually kind of quickly, get back above zero, that would turn this back to being positive. Since we're below zero, that means the summation index based on price is still declining as well as volume. We want to keep an eye on volume. These are two separate indicators. And you see how this is ticking just a little bit. sometimes this can lead us, but it can also lead us astray. So if we start to see volume begin to turn and go up and price hasn't done that yet, that could potentially be a heads up that we're turning positive. But there's other times when we've had false signals from that. So we want to be careful. The NYSE McClellan oscillator also, after being extreme negative, is bouncing back up and showing some improvement, but still below zero. So our summation index for the NYSE is continuing to decline based on price and volume. Also, the Swenlin trading oscillator. And I didn't show this in the what to watch video. I was just showing it here. But we're seeing some improvement with this Swenlin trading oscillator based on price and volume, but we're still below zero. Momentum, though, is still clearly negative. The PMO continues to decline. We're declining based on price and volume. And we're ticking back up with our PMO steady. This was another potential area of hope where we're seeing the PMOs that are rising are starting to go back up. We're turning up, but still extreme negative with the buy signals. We're still declining with the PMOs above zero. We've switched over to neutral with the Elder's Impulse system for the S&P. We're still negative with the parabolic SAR. The slope oscillator continues to be negative and starting to get more extreme negative. The MACD has crossed below the midpoint and is declining. That's still negative. All of our oscillators are negative. We're not really seeing any budge yet. And these are moving average based, and they measure momentum. And the momentum really hasn't changed yet, even with the bounce that we saw. And we're watching all the different moving averages here to see if we might be able to find some support and see more of an established bounce. We're still negative with the bullish percent index. We're below 50 and declining. So we didn't see an improvement there. And we're kind of flat right now with the NYSE bullish percent index, but we're still above 50. So that's slightly positive in that we're above 50, but it's negative since we've been declining. And we're getting a really extreme negative reading still with the bullish percent index for the NASDAQ 100. So we didn't see a bounce here with the inside of these indexes, the point and figure buy signals. We're not really seeing anything generated as of late, or as of yet, I should say. This is a new chart that I put together for the What to Watch video. This takes the NASDAQ 100 bullish percent index and just goes back over the last 20 years to show how we are getting an extreme negative reading, but we could still go down further. And you notice the really bad times, like this was the COVID plunge, this was a great financial crisis. It can get really, really ugly here. And there have been times when it's actually turned and gone the other way where we have had higher readings than what we have now, but we've also had lower readings than what we have now. Money flow turning back up a little bit, but still below 50. The ultimate oscillator is starting to get extreme negative, and it continues to decline. The vortex is still negative, even though the red line came down a little bit. We're turning back up with the RSI 14, and we're no longer extreme with the RSI 9. On balance volume is still below the moving average, even though it ticked up and the moving average is rolling over. That's negative. We're seeing a little bit of an improvement here with our 20-period moving averages. Those stocks inside of the S&P showing some improvement here. Also turning back up with the 50-period moving average study, 100-period moving average study, and 200-period moving average study. We saw a little bit of hope after Friday. We're seeing a continuation of that hope after Monday. On a momentum basis, though, the Copic curve is still negative. The Sean trend meter turning back up a little bit, but not really shifting over to more positive. And we're coming down to the lower end of this Ichimoku cloud, wondering if that's providing some kind of support. Keeping an eye on these possible fib retracement levels here, just in case we really continue to go down. We're still pretty high with standard deviation as we've been seeing a really fast descent of prices. That's why this kicked up, showing that the speed had really increased. We're still negative when we look at the Heiken Ashi chart. We're negative with the Keiki chart, but now we're pointing up. And we're negative with the Renko chart, negative with the three-line break. And we're just kind of keeping an eye on this. We've been completely focused, or at least I've been completely focused on this chart for a long time. If we come back up, now we're wondering if that 5110 to 5111 level, is it going to act as overhead resistance? And we're extreme with our 150 and 200 period moving averages. And we're negative in the short term, according to the Keller model. I'm more negative in the intermediate term, where it still has things negative here. And we saw a little bit of a change where we're, with our different indexes, we're negative in the short term with the S&P small caps, mid caps, and the NASDAQ 100. where we're turning more intermediate term negative with the small caps and the NASDAQ 100. No change here in the decision point card. And since we had the up day, other than the tech sector crossing below 20, which that's an extreme negative reading, so we might see some kind of a turn up from that because a lot of those companies are going to be, the big boys are going to be reporting earnings this week, but everything else ended up being positive with the S&P crossing back above 5,000. So we saw a little bit of a turn up here with the equal weight. That's the red line when compared to the S&P 500 weighted index. And we were up just a little bit here, not much of a change. We really saw this ratio coming down as the mega caps just got hammered on Friday. It ticked back up just a little bit after Monday. The Dow's been holding up for right now. We're back above this S2 level and ended up having an up day. But we continue to be neutral with the diamonds when looking at the Elders Impulse system. We also looked like we were in complete free fall with the NASDAQ. We were able to stage a bit of a bounce here. We were up 1.11%. Also a bounce of little over 1% with the NASDAQ 100. And we've gone from being negative to neutral with the QQQs for the Elders Impulse system. However, the momentum for the NASDAQ 100 is still negative. This is a little scarier. We're seeing a cross here where the 20 period moving average, that's the blue line, is now crossing below the 50 period moving average. And that's more negative. So we have to respect that on a trend basis. Small caps were up, but have a long way to go even to get back into the middle part of the range they've been in. And we continue to be neutral with the Elders Impulse system when looking at the small caps. We're coming right back up to this now resistance level here with the Russell 2000 small caps, turning up with the RSI after being extreme negative. We still have a longer term uptrend, but the momentum continues to be negative. The mid caps also bouncing up off of this support level. And if you watch the deep dive video where I rank the different indexes, the mid caps for the last couple of weeks have come in first place. And so maybe the market's king off of that. We actually came down to this S2 level because you're trying to figure out why are we bouncing where we're bouncing right now. It could be the mid caps that are actually giving us a sense of support. And we're continuing to be neutral, though, with the mid caps when looking at the Elders Impulse system. Apple is in a downtrend. It will be reporting this week, I believe. Tesla just continues to be just not very good right now and it is in a downtrend. NVIDIA bounced back up, but is still under its 50-day moving average. Microsoft bounced up as well, but still below its 50-day moving average. Meta, which all these stocks I think are going to report this week, it bounced up a little bit here. And Amazon dropped below its 50-period moving average and was able to come back up and get a little bit above its 50-day moving average. The FANG index showed a little bit of a bounce here, but is fallen below its 50-day moving average, even though it's still in a longer-term uptrend. The financial sector, and this is the area that I was pointing out over the weekend, at least this was a sector that was trying to come back to its 50-day moving average. Now we saw a bit more of a bounce here, and that could be positive for the market. And this is another thing that really spiked up on Friday, the staples to tech ratio. When this is going down, that means staples are underperforming and that tech is outperforming. We spiked up after Friday, and we're still continuing to show an even bigger spike after Monday's session. This could suggest more of a shift. Staples are defensive. Tech is growth. If this really catches fire and starts to go up more than just for a few days, we could be seeing a shift in the market environment. And the dollar was down slightly on Monday. This is also showing how the dollar has been declining just a little bit here. Oil is also continuing to decline after spiking up when geopolitical tensions were rising a week ago. And looking at the S&P compared to the world, where we're seeing a pretty strong correlated relationship here. We're all going down together as one happy globe right now. The longer term correlation is not really showing much of a change. And we bounced up just about 1% here with the total US stock ETF, but we're still below the 50-day moving average. Keeping an eye on bonds, we were up slightly with the yield on the 10-year. We were down slightly with the 10-year ETF based on price. Then our possible positive scenarios, not seeing an improvement here. And this is what's causing us some concern that maybe we're shifting away from a more pro-growth type of an environment to more of a value environment. because we're continuing to go down with the Qs to S&P, discretionary to S&P, and large cap growth compared to large cap value. We're continuing to go down with the large caps, mid caps, and small caps. And we're continuing to show some more weakness here with our 10-day average of the S&P 500 highs minus the lows. We dropped below 50. Saw a little bit of a bounce here with our 19-day exponential moving average of the advanced decline ratio. We bounced up based on price, but we're still negative. We also bounced up based on volume, but we're still negative. In broader market, we're still showing that the 5-period moving average of the highs minus the lows are negative. And we're seeing this really spiking up as well. The staples are outperforming the S&P right now. That's what happens when this spikes up, and that spike is continuing. And when this ratio is going up, that tends to put pressure on the S&P. Now I want to show you something here because I pointed this out over the weekend, and right now we are seeing some follow through. But I want to warn you about one thing. This chart, it's an NBD, next business day. So when I showed this chart over the weekend, I was showing you the reading for Thursday. And then we're getting the reading after Friday right now. And we had an update today. So we would assume, and you know what happens when you assume, but we still want to do that, that this could show some improvement. This is a ZWAG NYSE breadth thrust. When we get a really low reading, like we had in March of 2023, and then bust up out of that with some real power and get an extreme reading within 10 trading days, that's an NYSE breadth thrust. And that tends to be very positive for the market. Well, this one's pretty much gone now because they're usually around for about a year. We had another one that happened last October. We had an extreme negative reading, and then pow, we had a powerful up day, which set us to an extreme positive reading. And that has really been what's giving the market some support since that time. We did get extreme negative, and we came up a bit after Friday, but really this is Thursday's reading, and we're continuing to go up after Friday's reading with the up day. What we want to see, can we get up to this red line within 10 trading days? That would be another ZWAG NYSE breadth thrust, which could be very positive for the market. And these are very rare. To see two of them within the same year, that's really, really rare. And if we see another one here, that would be even like the cow's still alive rare. Okay. All right. So what's our outlook for Tuesday? This is going to be a really big week for earnings. We're going to have Microsoft, Meta, Tesla, and Alphabet are just among many that will be reporting. About 40% of the S&P 500 will end up reporting earnings by the end of the week. Our technicals were still negative in the short and intermediate term. We're below that support level, and we're still asking this question, are we seeing signs of bottoming? We've seen 2 days now with some hope that we can latch onto, but we need to see more follow through. And we're going to get the S&P Global Manufacturing and Services PMIs. Those will be coming out, and we're going to get new home sales. Not real massive economic reports, but things that we still pay attention to. We want to keep an eye on all the different geopolitical things, specifically between Iran and Israel. On Wednesday, we're going to get durable goods. On Thursday, that's when we get the first reading for the first quarter GDP. We're going to get the core PCE on Friday, as well as consumer sentiment. So you have a red box around the things here that are important or major that will be coming out. They consider this to be pretty important, but I don't usually see the market really pay attention to that so much. Seasonally, we're positive with the Dow, neutral to positive with the S&P, neutral to negative with the NASDAQ. How's that for being ambiguous? We're also within the week after options expiration now, where we do tend to be up 64% of the time and down 36% of the time. We'll be on the 17th trading day of the month, where when we look at the green dashed line, we see a little bit of positive seasonality here. And we were outperforming this top first quarter here, and then we've really been coming down. We're wondering, are we going to come back up and get more closer to what the average is during when we have a really solid first quarter? Tuesday is negative for the most part, but almost virtually unchanged compared to what happened in 2023. Also, we're coming into the latter part of April, where sometimes, according to this, we see some strength. But we look at this chart and we see a little bit of strength here. It's kind of chopping around going into the end of April. But then May sometimes can, this is where you get the old idea, sell in May and go away, because a lot of the best months tend to end after April, and then folks just sell and then go away for their summer vacations. So seasonally, we can see some pressure during an election year, even during an election year. And this also is put out by Goldman Sachs. I have been showing this in other videos where the first 2 weeks in May tend to be slightly negative, or they lack being positive, if you want to take it another way. Tom Bowley has us in this period of negativity right now, which will last until Wednesday before we tend to see more positive action going into the end of the month. The warning signs, and there's still a lot of negative things here. The parabolic SAR, the bullish percent index, both for the S&P and the NASDAQ 100, the chicken money flow, and it's extreme negative. The chicken oscillator, the ultimate oscillator is now extreme negative. The Copic curve, the vortex, and all of our oscillators are still negative. And we're still below short, intermediate, and long-term support. And our momentum for the NASDAQ 100 is still negative. We still have, on the positive side, the long-term trend. It's still positive. And this is another new addition. The equity put call ratio based on 5 periods is now going down, which is positive. In the financial sector, I should have changed that. It's not declining. It's positive, but bouncing after it had been declining. So our conclusion, we're negative. Okay, we don't want to front run this too much in case this is a dead cat bounce. So for right now, we are negative in the short and intermediate term, and we're still below support. Those bottoming signs that we're seeing, yeah, they're showing some more improvement. In the short term, we are bouncing after being oversold. Intermediate term, also showing a bounce, but we're still negative and we're still positive in the long term. Thank you. I hope you found this helpful. Have a really good day, and I will talk to you in the next video.